Visa and Mastercard will cost you $700 more a year as fees skyrocket. I'm your host, Steven Van Metre, and thanks for joining me today. And as many Americans turn to their credit cards to keep up with inflation, Visa and Mastercard are ignoring warnings and are about to hike their fees, and inflation's about to head even higher. Let's head over and pick this story up. With skyrocketing inflation, the NRF urges Visa, Mastercard to cancel swipe fee increases on merchants. And the National Retail Federation, the nation's largest retail trade group, is calling on Visa and Mastercard to cancel swipe fee increases as consumers battle skyrocketing inflation. And both companies are slated to increase swipe fees or fees imposed on merchants every time a consumer makes a purchase with their credit or debit card this month after delaying plans last year. And oftentimes these fees get pushed onto the consumer, and it makes a lot of sense because even if you're a cash paying customer, you have to think about it from the business perspective. When you go out and pick something off the shelf and walk over to the cash register, the business owner doesn't know how you're going to pay. And so what they're going to end up doing is raising prices on everything under the assumption that people will continue to still use their credit cards. Someone's got to absorb it, and it's going to be the consumer. Let's continue on, because according to the NRF, these increases drive up consumer prices amounting to more than $700 a year for the American family, and that is about $60 a month. If swipe fees increases are implemented, retailers are forced to raise prices on consumers in order to make up for the losses. However, this comes at a time when consumers are already struggling under the worst inflation in 4 decades. And again, we have this issue where suddenly we have the inflation that policymakers wanted. Now it's too much. Wages are not keeping up with it, and another $60 a month is about to hit consumer pocketbooks, and at the worst possible time. And since swipe fees are a percentage of the transaction, the cards automatically get more money whenever prices go up. So they're making billions more this year, even without the increase. And how do you know that? Because you can look over to the Consumer Price Index, which is running up at 8.6% from this time last year. And it makes perfect sense, because as consumer prices go up, well, so do the swipe fees. And that's how Visa and MasterCard are already making a mint now, and will wait till they raise their fees. They're going to rake in some big money. And last year, companies delayed the estimated $1.2 billion in increases, which are slated to take effect in April due to the economic fallout from the coronavirus pandemic. Now the industry is trying to create awareness of this issue in hopes of staving off these increases, again, amid continued economic uncertainty, inflation, and with COVID. There is one bit of good news in the economy where there isn't a lot of uncertainty, and that is actually in the unemployment claims data. Let's check this out, because perhaps there's going to be uncertainty coming to this much sooner than experts think. As jobless claims slipped lower last week amid tight labor market, according to the Wall Street Journal, where claims continue to hover around half-century lows as the economy recovers. Initial claims, a proxy for layoffs, decreased to 184,000 last week from 186,000 a week earlier, according to the Labor Department. And to put that in perspective, when we're in the low 200,000s, as we talked about in the past, that's considered a very tight, very robust labor market. The fact that we're under 200,000 and actually seeming to hold that level is just incredible. And it's a testament that employers want to hold on to employees. There are layoffs, but not that much. In fact, if we look at total claims, we see an even better picture for the labor market. That fell 88,000 last week to 1.622 million. And all that means is that people that are losing their job are having no problem finding new ones, or within relatively short order. And that's a sign of a good labor market. But will it last? Well, not according to the yield curve. Let's take a look at this. Where in blue we have the yield curve, the 10-year Treasury yield minus the 2-year Treasury yield. And against that, we have the 4-week moving average of initial claims in red set to a log scale just so we can look at it because of the pandemic surge. Well, we wouldn't be able to see the two lines together. And note that when the yield curve actually inverts and then starts to rise, we're going to be very close to a bottom in initial claims. And you can see it here again in the early 2000s. The yield curve bottom started to rise, signaling shortly thereafter initial claims headed up. And again, here before the Great Financial Crisis, the yield curve inverted and started to rise. and with a bit of a lag, and certainly following initial claims. We saw that happen before the pandemic. And now, what is the yield curve indicating? That perhaps rates are going to start coming down. And what we would see here in blue for this to rise, it would mean 2-year rates are going to fall faster than 10-year rates. And that's usually a marker of an incoming recession, and has historically suggested that initial claims are going to start rising. So we'll keep keeping an eye on that. But if you're not concerned about a recession, well, you probably should be. But you don't want to leave your portfolio high and dry in case there is. Be sure to check out Portfolio Shield. I'll put a link up there in the corner and the description below. Now let's continue on, because there are some indications that the labor market is actually pushing across to the manufacturing sector, and that maybe things are actually okay. Of course, the only question remains is how long. Here's the Philly Fed April 2022 Manufacturing Business Outlook Survey, with responses collected from just a week ago. And the manufacturing activity continued to expand in the region, according to the firms responding to the April Manufacturing Business Outlook Survey. The survey indicators for current general activity, shipments, and new orders declined from last month's readings, but remain positive, which is good news. It just means there's the growth of orders slowed, and the employment index and both price index edge higher and remain elevated. The future indicators for general activity and new orders fell sharply, but overall the firms continue to expect growth over the next 6 months. So before we get into the charts, all it means is growth is slowing down. So think of it: you're in your car, you've reached whatever speed you want to get to. There's a red light coming up, and you start to let off the gas. That's all we're seeing now. Is it just slowing down a little bit? Let's look at the charts, because current activity still is remaining at healthy levels, but future activity in black is suggesting that perhaps things are going to slow. The yield curve would actually be a strong indicator of that. But one thing we are seeing is manufacturers are being squeezed at the margin, meaning the prices they are paying here in orange versus what they're receiving in black remain a gap. And when we start to see these large gaps that you see here and back over here in 2008, well, it usually suggests that perhaps a recession is coming soon, because what that means from a consumer perspective is they're rejecting those higher prices. And then when you tack on perhaps another $700 a year or more in fees that retailers are going to have to pass on to consumers, well, you can only imagine those higher prices are going to be rejected. And again, that leads, as we know, to a recession. I'm Steve Van Metre. Thanks for being fans. Thanks for watching. Bye now.